Let's dive into Kenya's fixed income markets. Now, the sale of the first tranche of a $92 million bond being issued by the Kenya Mortgage Refinancing Company closes on Friday, the 18th of February. The company is looking to raise at least $12 million in this first tranche at a coupon rate of 12.5%. Pretty decent number. But remember, KMRC was set up to make long-term, cheap financing for homes available by getting banks and savings and credit societies access to a lot cheaper long-term debt. Despite being home to around 50 million people, Kenya has less than 30,000 mortgage accounts, and that was by the end of 2020. Now, the size of the outstanding mortgage portfolio, in fact, actually fell in the first year of the pandemic to barely over $2 billion. Now, even at an average interest rate of 10.9%, most mortgages are simply unaffordable to a majority of Kenyans. 8 out of every 10 mortgages in the market right now are on a variable rate. Most have a tenor of around 11 years. The typical mortgage loan in the country is close to $76,000. So back to our original question. If KMRC is borrowing from the markets at 12.5%, how can it possibly lower the cost of mortgages into the single digits? That's why I started my conversation with Johnston Oltetia. He's the CEO at the agency.
So that issue closed yesterday, and you saw what happened. It suddenly was oversubscribed.
Huge amounts of liquidity.
By what? About 176% oversubscription.
Yep, $1.1 billion in bids.
That suddenly the market is super liquid, and investors are looking for a home for part of that of their investment. And so that means that the KMRC bond essentially provides part of that need, a home for where investors will put the money. So in fact, we think that is the greatest thing that has happened to us, because with that kind of a subscription, you can see that there is a significant market appetite. And suddenly this instrument, which is obviously providing a higher income than the government security, will suddenly attract that kind of financing that came to the market and obviously didn't find a home.
At the moment, I know your offer is closing tomorrow. Do you have a feel for what the order book is looking like at the moment? What sort of bids are coming in?
So, we're certainly collecting commitments right now. So we have obviously the transaction advisor running around trying to get the commitments from the investors, signing in on the application forms. So we understand that process is running in very smoothly. It's actually running in well. So we would certainly be looking at this tomorrow when we have the issue closed, but we are certainly confident that we'll get the full subscription or potentially, in fact, get an oversubscription.
I'll get around to the mortgage side of it in just a moment, but let's look at how you operate, because as I understand it, you're supposed to on-lend this money at single-digit rates. I believe your target pricing is 5.6% to banks for them to then be able to lend to individuals in single digits. But if you're borrowing from the market at 12.5%, how much extra capital would you have to raise in order to blend your cost of capital down to that single digit level, to at least lower than 5.6%?
So we look at it this way. So we look at the cost of funds. So when you look at currently the cost of funds, we only have at the moment, at least for purposes of on lending, one source of funds, and that is funding from the World Bank and the African Development Bank, which is essentially coming in form of a sovereign. Now, our cost of funds for that, of course, is concessional. So we get, about less than 5% in terms of the cost of funds at the moment, and that's why we are lending at about 5% to the primary mortgage lenders. We essentially are taking a large pool of concessional resources and blending with market-based resources that we have. And because we essentially are a very lean institution, we're also managing our costs significantly. So when you look at the cost of funds on average, or the weighted average cost of funds after the blending, we get it at about 5.1% or something like that, which is not too dissimilar with what we're currently lending at. That means that we're going to increase slightly the rate at which we are lending, after we have blended the resources with the capital markets funds.
What sort of number do you have in mind? When you lend onto these banks, let's assume for sake of argument, it moves up from 5.6% to 6%. What is there a specific rate at which banks are then obliged to provide mortgages at if they take money from KMRC?
So, we are certainly not creating an obligation, but we anticipate that the financial institutions will pass a benefit to the people, and that is part of the covenants that we have with these financial institutions. But when you look at the rate at which all the financial institutions that have received money from KMRC so far, they're lending at 9.5, 9.8, and that kind of thing. So even with 40 basis points increase or 60 basis point increase, we don't expect that to go beyond 10%.
Yeah, but a 9% mortgage compared to the average in the market from banks now, which is around 12, 13% in some cases. I mean, that doesn't sound like a very significant drop, considering that they're essentially getting this money from KMRC at, say, for argument's sake, 6%. Why isn't it feasible for them to drop that number even lower, perhaps even 8%, 7%?
So, it all depends on the efficiencies within the financial institutions, and I cannot talk for them. But it's essentially usually the rate, the way the financial institution look at a borrower. So, of course, they do the credit assessments and the risk of the borrowers and things like that. And they look at their costs, which is essentially the origination cost that they incur. So that is within them, but of course, our ask to the financial institutions is that they need to retain single digits so that they can retain affordability.